when you're at an amusement park, people are on the roller coaster, they're yelling, they're screaming, they're scared. They might be excited, but at the end of the day, they kind of want to get off eventually, right? You get onto a carousel and you hear those people screaming, but when you have an ERT solution, you have stability. You know exactly what your risk looks like in years from now.
Welcome to the Leader's Edge podcast. I'm Sandy Laycox, Editor-in-Chief of Leader's Edge. In this podcast, recorded on-site with Allianz at the 2025 Insurance Leadership Forum, I talk with Darren Tasker, Head of Construction, and Tom Houlihan, Head of Alternative Risk Transfer at Allianz Commercial. We take a deep dive into the construction line of business, looking at the current risk landscape, where construction investments are being made, and how alternative risk transfer is playing a role early and often. First, Darren gives us an overview of the construction risk landscape.
On the builder's risk side, you're seeing a shift towards a change in NatCat focus. So, predominantly we're very focused on CalQuake and Florida windstorm and those typical events. Now, with the amount of severe convective storms that are occurring and becoming more frequent, and where the construction activity is happening in areas that are seeing more of this activity, it's being more of a focused, and you're seeing that being reflected in the terms and conditions and the capacity that's being deployed. And I would also say that, there's been a slight shift in the types of projects as well. I mean, we saw a lot coming out of the pandemic, a lot of manufacturing, onshoring, and, now we're seeing in that realm, data centers, and we'll get into data centers later as well, but a lot of that type of construction. And then, of course, a lot of infrastructure spend coming, the aging infrastructure in this country. Investments are starting to come through. So we're seeing a lot there. But I would say overall, the market is relatively stable. But certainly, on the property side, there's a shift in a softening of the market. We're seeing a lot more capacity, and that's sort of impacting the placements. But things, I would say it's more stable than the general property, which we've seen, a sharp decline in rates this year.
One of the things affecting the global CAT costs is more urbanization. It sounds like more building in urban areas and less ability to soak up the flooding and those types of things. So I wonder if that's kind of playing out in your property in that way.
Yeah. We're building in areas that we've historically not built, and how does that have an impact on the environment and how things or how those assets react when there's an event. Where is the water going to go when there's a flood, or in areas where, like I mentioned, there's more activity in terms of severe convective storm, because where we're seeing the investments like a data center, you need a lot of space.
Yeah.
So they're in more remote areas as well. So not even the urbanization. You're also seeing an uptick in construction activity in rural areas. But on that front, the concerns is more around severe convective storm.
We then talk specifically about the risks of labor shortages and tariffs on construction and the role of risk management in these cases.
From a labor standpoint, there has been a construction boom, and then with the amount of investments in these data centers, it's putting a strain on the labor market, and there's certainly a shortage. So it's very much a concern for our clients on how do they secure the adequate talent and resources when they're selecting their contractors and subcontractors in order to have the talent to execute the project in an efficient way, and how that sort of translates to our product on the builder's risk side. The prominent coverage / exclusion is one that provides coverage for faulty workmanship, design, defect, and so that if there is a lack of that, could impact loss activity on the construction policies. So, it's certainly something that we're monitoring. It's certainly something that we see in our underwriting assessment to make sure that the clients that we are engaging with, are well positioned in that regard. And I would say, the big players in these spaces, we were talking about the data centers, the big clients, the hyperscalers that are heavily invested in it, they can sort of leverage their economies of scale and their clout and the amount of investment to make sure that they're getting the top contractor talent in order to execute the project.
Are you seeing any slowdowns of building because of labor, or projects that are, not?
No, I mean we're not seeing things being delayed because of it. If any delays that occur, which was sort of the second point to your question around tariffs, I would say any pauses or delays have been more related to that, where the little bit of economic uncertainty. So certain clients may take a pause and, does this make economic sense? Do we want to maybe wait until things sort of calm down a little bit and we have a little more certainty? Because, these projects are typically 3, 4, 5 years out. So, you're not going to get the economic benefit from it until years. So you don't want to be well down the road and heavily invested in it, and then it no longer becomes economically viable. However, even though we've seen some pauses and some cancellations of projects or investments, we're now seeing that clients are acknowledging the new economic world and the environment, and we've seen sort of an uptick in very, very recently on projects where we've had quotes out there for a while on hold are now binding, which is great for us.
Yeah. What about from a risk management perspective? How are you all proactively working with clients and brokers to help sort of maybe preempt some of these changing risks in the construction area?
Yeah, I would say one of the things that we're doing is insisting that we get involved early in the process. That I think if you want the best terms and conditions, you need to get the underwriter and their engineer most comfortable with the risk. And so I think engaging them early and outlining what are the concerns, what is the information that is needed in order to make a solid underwriting decision and to put your best foot forward with the best quote possible. And then also, things are getting more and more complex. So there's certain bespoke solutions that are required. Let's get out ahead of that early. Let's try to wrap our heads around it collaboratively and come up with solutions together, rather than waiting until the very end when there is a time crunch and we're just trying to get it done. Yeah. So, and then that could also lead into, when I'm talking about bespoke solutions or maybe certain coverages that are from the traditional sense uninsurable. Maybe we can bring in our ART folks to the table that may help the client provide some coverage in areas that the traditional markets aren't able to deliver on.
We move into alternative risk transfer, and Tom shares the importance of early involvement of the alternative risk transfer team when serving clients.
When you start talking about alternative risk transfer, engaging early is vital, right? Inherent in our solutions is an element of risk retention on the client's behalf. And so they have to engage your entire organization to start thinking about risk differently. And once you start thinking about risk differently, you're going to be starting looking at strategies that are going to be multi-year, that are going to look very different than traditional insurance, but are going to act like traditional insurance. So you do have to engage early. You have to start engaging CFOs, treasurers. This goes way beyond just the risk management teams at the clients. The earlier the better. And what alternative risk transfer allows our clients to do is kind of get off of what I like to call the roller coaster of traditional insurance and jump on the carousel of stability that ART Solutions brings. A lot of times when you're at an amusement park, when people are on the roller coaster, they're yelling, they're screaming, they're scared. They might be excited, but at the end of the day, they kind of want to get off eventually, right?
Fair.
You get onto a carousel and you hear those people screaming, but when you have an ERT solution, you have stability. You know exactly what your risk looks like in years from now, right? Which you don't have that solid thought process, especially when we talk about practice policies, where, and from a liability perspective, we're in a very hard market right now, and clients are feeling a lot of pain, right? They want that stability. They want that long-term understanding of what's happening with their volatility. We're helping them manage that, and so engaging really early in the process is very important.
Tom then shares what types of solutions are most resonating with clients currently.
The primary solution that we deliver is usually it's a 3 to 5 year policy. And again, this has been very active in the practice policy space, right? So we're working on some solutions from a project standpoint, but what's resonating now is that practice policy. And it really is now in the liability space where clients are facing a lot of pressure, especially if they have large auto fleets, or maybe if they have wildfire exposure, New York labor law. There's a lot of pricing pressure that the market is putting on these type of risks, or they're looking for higher attachment points. They're saying, you know what, we're not going to want to attach where we used to. We're pushing higher and higher, and what clients are coming to us for is, hey, you know what, we're not comfortable retaining the risk on that layer completely. We're willing to retain some of it, but we want some risk transfer behind it if it's a lot worse than we expect. And that's where these solutions come in, because the client's going to be taking, maybe 1 per occurrence, maybe 2 per occurrence. But if things get really hairy, they've got risk transfer and a structured solution. And that's why I was talking about kind of the carousel analogy, because, they know exactly where they're going to end up, right? You're going in a circle, you're on steady ground, where, traditional market buying is year in and year out. You're not sure where you're going to end up. You're not sure what attachment point you're going to be at, what kind of terms and conditions you're going to be seeing, what kind of price. This gives that stability. So that's what we're seeing really resonating with clients today.
With data centers top of mind among conference attendees, we take a deep dive on what it takes to build them and how that risk gets insured.
They're massive facilities, but they do range in size. We're getting some in the 20 plus billion, which is across how many football fields. So it's just difficult to visualize the scale of these facilities. But there are even some smaller ones, but even the smaller ones are still 300 to 500 million. So it's not insignificant capacity. And then you're also seeing a lot of where they're initially just building what we call the core and shell of the facility, and then the separate company at times will come and install the equipment, the servers, and everything else. So it's a challenge to, in some cases, from the size and scale, to fully assess the risk, and when there's a phase approach to sort of determine, what is our maximum exposure here, and because of the values there that we're talking about, and the potential exposure to severe convective storm, what's our maximum exposure? What is the most capacity that we're able to deploy? And then, I would say, again, as I mentioned off the top, from a faulty workmanship design defect perspective, making sure that these projects are executed properly and without loss. I would also, another major focus or concern when underwriting is the sheer business interruption values, or what delayed start. We have some where it's $10 million a day lost revenue. So whenever the client wants to insure that exposure, that significantly impacts how we assess, potentially how the capacity that we deploy, because that's going to impact our PML scenario or MFL scenario, and making sure that also with the amount of projects that are occurring, that there may be some supply chain issues. So if something does go wrong, is the client going to be able to procure the replacement in a time when the meters is ticking and we're on risk? So I would say those are the major focuses for ensuring these on the property side. I mean, on the liability side, maybe from a professional, there's some heavy exposures, but and Tom mentioned wildfires on the general liability side, but I would say on the property side, there's major exposures.
Yes, it seems like there would be you have the physical, you have the digital. It seems like there's a lot going on there. And is this a good place for alternative risk opportunities?
I mean, first of all, this is one of the hottest topics of the CIAB. Everyone's talking about the data centers.
Is that what you're hearing on the ground?
That's what I'm hearing on the ground.
Yeah.
And, it's not just the preponderance of these projects that are coming out, but it's also the massive scale that we're talking about and the capacity required by the clients that are putting these into place that's needed. And frankly, it's capacity that's beyond the marketplace as it stands now. Right, and this is where alternative risk financing, alternative risk capital comes into play, because we're definitely thinking about it in the ART space. How can we provide capacity? How can we provide solutions to this issue, which is very much, like I said, at the top of everybody's mind, in a way that's going to be unique. And one of the really cool things about Allianz is that the capacity that we deploy in an alternative risk setting is separate and distinct from what we're putting up on a traditional. Most carriers don't have that ability. We do, which means what Darren's able to put up on the traditional side, for instance, in the builder's risk, we can provide some solutions, not only from a builder's risk property standpoint, but also from a liability standpoint, from a PI standpoint. And we can look at how we're putting these things together in a single solution for clients, across all of these multiple lines of business that are being impacted by these massive projects. So we're working pretty hard to figure out how to make this work for clients and working closely with brokers to come up with solutions. We see this as a really important way forward for the market to really address what's coming.
So from the broker perspective, are you finding that alternative risk transfer solutions are kind of a game changer in your ability to work with them and support them in what they're looking for as they go out and try to serve these clients?
Absolutely. I mean, what we found in the last few years, this goes beyond construction, right? This just goes to the marketplace in general. In the last few years, a lot of our broker partners have set up their own alternative risk groups within their broking abilities, right? Not all, but just about every broker we talk to is talking to us about what we can deliver to them in this way. It's not really alternative anymore, right? We're now starting to think about it as complementary risk transfer, not alternative risk transfer. And I have to give Thomas Little-Lind, our CEO, a little peg for that, because that was his term. It's not alternative, right? This is a strategy that clients, whether they want to or not sometimes are coming to, but now it's really looked at as more of a long-term solution. It's been in vogue, it's been around for a long time, it's nothing necessarily new, but the scale, with what we're seeing now, there's a lot more entrance into the space, providing capacity in an ART way. This is not slowing down. This is something that's speeding up, and it's not dependent on hard markets anymore. That was another thing. It used to be really driven by increasing costs, right? But now clients are understanding that the benefits are not just from a cost perspective, right? It's that managing the volatility long term. It's managing attachment points. It's managing how much risk they're retaining. So the brokers are coming to us constantly with problems that they need solving, not just with big clients, but also with mid-market and smaller clients as well.
Yeah, because their risk is also becoming so complex that it's not enough to just have a standard.
Exactly. Yeah.
Wow,
I mean, again, they're also forced to sometimes take higher attachment points than they prefer. And because we've been able to simplify a lot of these programs, they used to be way more complex than they are today. at Allianz, we've been able to do these much quicker. We've been able to get back to our clients and our brokers much quicker than we used to. And like we talked earlier about how vital it is to talk about some of this stuff early. That being said, we do have the capability of turning around these things a lot quicker than we used to. And so it's easier for our broker partners to put this into their strategy, even if it's a short-term solution that they're looking for.
Finally, Darren and Tom share some conference takeaways.
In every meeting, there are meetings that we've sort of brought, the entire team and product together to represent the company. But every meeting, construction was at the forefront of these conversations. And I think last year was the same, and this year also. I think it just speaks to the amount of activity in the construction space that we're seeing, and the opportunity, and everyone trying to capitalize and sort of meet the moment and be there for the clients, and that we think will deliver hopefully profitable business on all sides. So we talk about the data centers and throwing out big numbers like $5.2 trillion in expected cost by 2030. I mean, these are just astronomical numbers. But also on the energy side, I mean, these data centers are very energy consumers, and so there's that's a big component of it as well, that needs to be in lockstep with this, and that's also where they decide. Often when they decide where to build these data centers, is that infrastructure already there, or do we need to build the energy infrastructure in conjunction with the data centers? So I would say that has been a hot topic throughout, but just construction in general, and meeting the moment, meeting the demand, I think has been consistent throughout.
Definitely the same things. I mean, ART is also definitely at the front of everybody's minds. Like I said, not just from a construction perspective, but across the board. Everybody's looking at ways of providing solutions for their clients, and it's across the board, right? I mean, what you're seeing, for instance, in the liability market with litigation financing and these nuclear verdicts, right? Nobody's expecting a softening of that marketplace anytime soon, and they recognize the benefit that alternative risk solutions have in that space. And then on the property side, where we have a lot of capacity and we have a lot of stability at the moment, there's a recognition out there too that could change on a dime.
Right, with one storm.
One storm, And I was on a panel a few weeks ago when we were talking about this, and the way it was kind of set up was, we've got some steady waters at the moment, but below it is potential storm, right? I mean, it's there. It's just a matter of time. And so some of our brokers and some of our clients are still thinking about it from a long-term perspective strategically now, which is something that I actually think is a really good way of doing it, right? Is looking at your risk when you have the capacity to, and you're not looking at a hard market situation where you have to make a knee-jerk reaction and jump into something, but actually take the time now and look at your property portfolio and look at how there may be better ways of increasing your capacity and taking on a little more risk in the softer market. And you might want to do that now before those storms start coming, and next year or the year after it looks a little bit different, because it's just a matter of time.
That was Darren Tasker, Head of Construction, and Tom Houlihan, Head of Alternative Risk Transfer at Allianz Commercial, joining me at the 2025 Insurance Leadership Forum. I hope you enjoyed our conversation. For more Leaders Edge podcasts, subscribe at leadersedge.com.